Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at quarter three of Netflix. They just reported earnings, and I hope you guys saw that drop, that jump, that flat move that Netflix ended up doing. If you guys saw after hours, the stock went up all the way to $310, so almost a $16, $17 price increase. It ended the day with about a $6 increase compared to how it ended before earnings, which was a nice 2 to 3% gain. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how this company is doing. So let's get started. If you guys saw my last episode, the last episode I posted was a recap on things I'm going to look at for quarter three earnings. I'm glad I did that episode because I was so familiar with what was going on with this company when I was reading their shareholder letter and watching their video. So I hope it provided you guys with the value. It's the same value it provided me, and I promise to post more content like that. All the information collected today came from Netflix investors website. I also use seekingalpha.com to collect a few data, but most of the information came from shareholder letter and the earnings video that they post on YouTube, which they call live video, but it's recorded already. The first thing we're going to talk about is earnings. They announced October 16, 2019. Earnings per share were $1.47, which beat by 42 cents. That's definitely a huge beat, and I can understand why there was that huge jump to after hours when they saw this. Revenue was $5.24 billion, and it missed by less than $3 million. So less than $3 million compared to that $5.24 billion is a very low number. So to me, that means the revenue was pretty flat. So for that reason, the first point is going to have to go to Bull Solo. Next, we're going to take a look at some of the top topics here in quarter three. And this is comparing to quarter three a year ago of 2018. So revenue grew up to $5.2 billion, which is up 31% over the prior year. Revenue growth has been accelerating as United States average return per user increased 16.5% year over year in quarter three. So obviously we see that annual return per user increased because one, they're cutting costs, and they're cutting costs to keep these users, and they're also increasing the price, which at the end is going to overall help increase the average return per user. Operating income doubled to $1 billion. Paid net ads came in at 6.8 million compared to the 7 million forecast. I don't think that was a miss. I mean, that's pretty close to that 7 million. And that they ended up doing pretty good here as well. I honestly thought that they were going to take a big hit in ads this year, but it does not see in this quarter. But that they proved me wrong. So, and this was compared to quarter three a year ago, which was $6.1 million, 6.1 million net ads. But one thing to note is right now, international, like we're going to see in a bit, international users is what's making Netflix grow all these subscribers. Operating margins was up 18.7%, up 670 basis points. So a year ago, this was 12%. And this is I think a pretty tricky part, and I don't like Netflix doing this. So one of the reasons quarter one, quarter two had a higher operating margins was because they keep saying that they have this expense coming in, but it didn't happen this quarter, and it didn't happen this quarter. We're pushing it up. But because of that, we beat expectation on operating margins. And they're doing the same thing here. Operating margins, they say, is up 670 basis points and was above their guidance due to the timing of content and marketing spend, which will be more weighted to Q4 2019. So what, I mean, this expense, how long is it taking? I saw it in quarter one that they said it was going to go in quarter two. I saw it in quarter two. They said this expense, our operating margins is so high right now, but it's due to this content expense moving on to the second half of the quarter, of the year. And now they're saying here in quarter three, when we're in the second half, hey, this weighted expense is going to hit us hard in quarter four. So this is something I don't like. I feel like they're trying to flip some legs here, and this is one thing that gives me a bad taste. Earnings per share amounted to $1.47 versus the 89 cents, and included but this included $171 million in non-cash unrealized gain. So this was 171 million that they did not think was gonna come in this quarter. So if we take a look in the previous quarter, they beat earnings per share by 42 cents. So remember, they beat earnings per share by 42 cents. But let's say we didn't count this 171 million non-cash unrealized gains, they would lose 37 cents of that 42 cents. So they actually only beat earnings per share by 5 cents. This is things, right? It's one-time things like this that really affect the company and don't help you see how the company is doing overall. So in reality, this number should be $1.10 versus 89 cents. And it's just something I thought I should share with you guys. But overall, the information that they gave us was pretty good. So again, I'm gonna have to give another point for Bull Solo. Except those, I just want you guys as investors to know those two bottom points are very important and something I want to keep an eye on, right? That earnings per share of $1.47 was because of that not unrealized gain previously, and it accounts for 37 cents. And then that operating margin trick that they're trying to pull, I don't think they're trying to pull on us. I think it's actually just might be moving back. I'm giving them the benefit of the doubt. But they keep saying that, so people are expecting lower operating margins, and then they come in during earnings and they're like, "Hey, actually, guys, we tricked you. We beat our guidance in operating margins." So now we're going to talk about one of the most important things on Netflix, and it's their subscriber growth. So here we have quarter three. We see they did miss by 0.2 million, but like I mentioned, they're pretty much on target. And one thing I do like about Netflix, even though they do have their bad things, and one thing I do like is that they go and they strive for accuracy and not conservatism. So when they give you a number, this is a number that they're trying really hard to achieve. It's not a number they know they will achieve. It's a number they really go for and try to achieve. So another growth, subscriber growth continue. In the United States, they got a total of 0.5 million new users. Their forecast was 0.8 million, so they missed on that. And that's where we see that drop that's where we see that miss in the net ads, right? They missed by 0.3 million in United States, so they missed the overall growth by 0.2 millions. Net ads first 9 months of 2018 was 4.1 million. For the first 9 months of 2019 was 2.1 million. So we can see there is a slowness going on in the United States market, but that is okay. I mean, that's understandable because the United States market is their most updated, not updated, what's the word? It's their most growth? No, it's not growth. What word am I trying to look for here? Is there more evolved market? Let's just go with evolved market. But since the U.S. price increase earlier this year, that has also slowed down U.S. membership growth. And Netflix has said this, and this is something that we're going to see how much more growth is it going to slow down with. International paid net ads totaled $6.3 million in quarter three, a 23% increase compared to the 5.1 million a year ago. And it was slightly above the 6.2 million guidance forecast. So right, they missed by 0.3 million in United States, but they made 1.1 million more in international, which gave them the minus 0.2 million compared to their forecast, which I said, I think this is actually okay, good numbers. So this is more of their subscriber growth. One thing I wanted to do was take a look at the chart to your left, which quarter three forecast was the one from last earnings, quarter four, one with the quarter four forecast is the one for this earning. And we can see, right, they're pretty on track with what they thought they would go. And they're pretty close to 2018, which was a very strong year for them. So right now, subscriber growth, I think, is doing pretty good. They took that setback in quarter two, but look, they made it right back to where it's at. And I do think Bull Solo deserves a point on here. So I promised just one more slide on subscriber growth. I think, yep, one more slide on subscriber growth. One thing I do like here is we can see developed. That was the word, developed. We can see here we have their revenue and everything broken down by U.S. streaming and international streaming. In U.S. streaming, we can see that first thing, contribution margins has increased a lot over the past quarters compared to quarter three of last year. And that to me is telling me, right, the company, once they have their users, once the market is developed, they're really able to increase their margins. So right now, right, they've increased their margins not by a much. Same time last year, quarter three was 35%. This year was 41%. But I don't know, right? Are we taking it? This is something we have to understand. Is that 1.7 million gain included in here? Is any of that included here that helps gain that much money? And also, we did not use a lot of the expenses this quarter. That's another thing that would help out. But we're still seeing growth. Quarter four last year was 29.6% of contribution margins, which I think is their profit margins. And this quarter is 31 points, and this quarter four forecast is 31.6%. We're going to take a look at paid subscriber growth. They are expecting 0.6 million subscribers to grow in the United States for quarter four, and they are expecting 7 million subscribers to grow international for quarter four, even though international a year ago was actually $7.31 million. So I wonder what's happening with that slowdown there. All right, now we're going to talk about quarter four and some forecasts they have. For quarter four, they're expecting revenue to increase 30% year over year, and they're expecting streaming average return per user to grow 9%. Both great numbers, right? You want to see revenue increase, and you want to see return per user increasing. Both over almost double digits, and those are great numbers. Forecasting a 7.6 million global paid net adds compared to that 8.8 million last quarter. And we can see one of the big things was United States. The two things is United States is slowing down, and they're even having a slowdown in international, right? United States last quarter four last year was 1.5 million compared to 0.6 million this quarter, and net additional ads last quarter for quarter four was 7.31, where international this year is 7 million. So they are decreasing their growth in both international and United States market, and that's why we see 7.6 million compared to 8.8 million last quarter. This implies full year 2019 paid net adds to be $2.6 million, 2.6 million subscribers, down from the 28.6 million last year. So it's down about 2 million subscriber growth compared to last year. But I mean, is that a good or bad thing? I mean, last year was definitely a strong year for Netflix. I'm not going to lie. That subscriber growth was insane. But 26.7 million, if we take a look at this chart forecast, it's still going to be a very strong year. The only thing, right, is they are going to be down when they were expecting a higher net adds. And here they mentioned that the current forecast reflects several factors, including one, the first thing they're including is quarter four. They're releasing a lot of new content in quarter four, but opposed to quarter three, where quarter three had a lot of returning seasons. So it had returning seasons of Papel Heist, Casa de Papel, House Heist, the Money Heist show. It had what was that other big one? Stranger Things. It had a few shows that were returning seasons. So they knew that they had developed a form of users, of customers watching those shows. Now this quarter they're doing a lot of new IP, a lot of new content, never before seen. So they don't know how this is gonna do. So that's the first reason that they believe net ads is gonna be down year over year. The second is they do say that there is a minor, they say minor, but it's still there, a minor elevator churn in response to the price changes. This pretty much is saying that they are losing some growth in subscribers due to the increase in price. There's no other way to put it. The next is they are also saying that the new forthcoming competition will affect them. But they're saying this is only in the short term. In the long term outlook, their business is still unchanged. For this is actually I think it's a good point for both Bull Solo and Darth Bear here. The reason Bull Solo is good here is there's still a strong increase in revenue, and there's still a strong increase in average return per users. There's still also, even though global forecast is down compared to the same time last quarter, they're still going to have a very strong subscriber growth in quarter four if they meet expectations. But I do think Darth Bear also deserves a point because net paid ads are down compared to last year. This should be a growing company. Every year, this company should have higher subscriber growth. And now they mentioned that they're having a slowdown in both international and United States. Another point for Darth Bear, right? So I'm going to end up giving 1 point to each, but I'm just making the reasons why I'm giving a point to each. They're also saying that even though they're being pretty quiet about it, they're saying that their price increase and the competition will definitely have some short-term effect in the company. So that's why Darth Bear and Bull Solo get a point. Next, we're going to talk about the content they are releasing and how they're releasing it. They are expanding their non-English language originals because they continue to help grow their penetration into international markets. And when they mentioned here, they mentioned of a nice amount of shows. I'm not going to bore you guys with all the shows, but they listed a few shows that have done amazing outside the English language and have broken like records in like Brazil and India and all these other things. They're also having much work to do in Asia in the coming years, and they're seeing encouraging signs of progress there. To this date, they have globally released 100 seasons of local languages, original scripted series from 17 countries, and have planned for 130 more in 2020. They also plan to expand their investments in local languages, original films, and unscripted series. They're also, this is one thing I don't like, it's something that has to happen. They're investing aggressively in original films and making great progress with improving results. Right now, with all the competition, a lot of their meat and bones are coming out of the showings they have there. Because, for example, Disney's going to take out most of their Disney stuff for Disney Plus, and the only way Netflix can combat this is by making original films. But it is pretty expensive to do this. But one good thing is some of the original films for Q4 have some strong big names. They have Robert De Niro, Al Pacino, Scarlett Johansson, Eddie Murphy, Ryan Reynolds. They have a nice amount of movies coming out with these big actors that might actually help out, and it's pretty cool to see that they're actually having big names coming into Netflix. I think last quarter was the first time some big producer or writer was actually making a film for Netflix, and this is definitely going to provide some great overall publicity to Netflix. Here I'm not going to give a point to Bull Solo or Darth Bear. I don't think any of this deserves a point. Their marketing strategy. This is pretty intriguing to me. They rolled out a lower price mobile plan in India in July, and they're pleased with the result. So if you guys saw my last video, you guys would have seen that I did talk about this new plan that they're trying to release. It's a pretty cheap plan. I think it's like a $4, $5 subscriber per month. But it only allows them to view one mobile screen at a time, I believe. And they're doing this because in countries like India, TV is actually pretty cheap. So by giving them the full all around $13 subscriber cost, it's not going to entice people to go there. But if they have a single mobile plan, that's definitely a great way to go about it. They approach with pricing, so they're pleased with the results, and so far their approach with pricing is to grow revenue. So they're saying that, right, this pricing, the way they did this pricing is they're gonna collect a bit amount. I mean, with $5 a month, how much return are you actually collecting? They're gonna be collecting they're gonna be collecting revenue here, and so far the retention and uptake on the mobile plan in India has been better than their initial testing suggested. So that's good news. With this extra revenue, it will allow them to invest more in India content. And then now it's that circle, right? Now they have that revenue. They're making India content. They'll be able to get more subscribers, more revenue, more India content, and so forth, so far, until that wheel is spinning on itself. And they'll be able to pull out cash from there and send it to another market. They're still only a very small percentage of their total subscriber base is on the mobile-only plans, they are testing it in other markets. And the only thing I don't like about this subscriber-based plan is the subscribers they grow here, their average return per user is definitely going to be pretty small compared to the normal subscriber plan. But they're still going to end up adding these subscriber growth into the pile of total subscriber growth. But that to me is gonna be like a little misleading, because they're gonna be like, yeah, we grew by a million subscribers due to this mobile plan. But this mobile plan, so we're gonna see subscriber growth jump ridiculously. But in reality, the revenue and the margins collected with this is gonna be pretty low. And that's something I'm not looking forward to. I mean, I have to do extra work and really dig in on hoping that they split up on what kind of subscribers came from what kind of plans. But that's at the end of the day, it is what it is. And they continue to expand partners on bundle offerings in different countries. They have bundles with Sky Italia, which I'm guessing is in Italy. They have one in France. They have one in Japan. They have in Mexico. So this is that publicity to start growing that international growth. And we can see they're going pretty strong. They also just localized their service in Vietnamese, Hungarian, and Czech, so that more entertainment fans can enjoy thousands of hours of TV in their preferred language. So I think that's pretty good, right? There is places where Netflix can grow, but one thing that I think is bad by being one of the first uprunners of the company is now that all this competition is coming into the market. They can look at you guys, they can look at Netflix, and they can study what Netflix has done, and they don't have to spend all this time working on it. Now they already know what works because Netflix has provided all the information, so they can come in a lot faster than Netflix. Competition. So this is how Netflix annoys me a lot. Yes, I don't know why I didn't see it last quarter. But I saw it this quarter. It's really I was able to pick up on it. Last quarter they said that, hey, in the United States, the most developed market, we still only earn about 10% of the consumers' television time and less of their mobile screen time. So they have much room for growth. So they're saying what? There's still 90% of the market for us to attack in the television time and less in mobile time. So there's room to grow. So it doesn't matter if competition comes. It doesn't matter if Disney Plus comes. It doesn't matter if Apple TV comes. But then they talk about this chart I'm about to look at in a second. Let me continue with the next points. But remember that point. The launch of the new services, they say, will be noisy. There may be some modest headwind to near-term growth, and they have tried to factor that into their guidance. That's good. I'm glad to know that. In the long term, they expect to continue growth nicely given the large market opportunity. Hey, I'm glad with your optimism. It's pretty good. And then they show us this chart. So in this chart, they give us an example of where Canada and the United States growth, where Canada does not have Hulu, but the United States does have Hulu. So they're trying to show us that, hey, Canada and Hulu, Canada, there's no Hulu, but our subscriber growth is pretty much the same. It's pretty much the same when we take a look at United States, which has Hulu. So there's no point to worry about competition. But that's not what I got from this chart. From the previous statement, right, I was pretty happy. I'm like, hey, there's 90% of the market still available for Netflix to keep attack on. But, so it doesn't matter if competition comes. But this new chart gives me some other perspective. If we take a look at this chart, it tells us Netflix paid membership as a percentage of total broadband household by market. So this is telling me that 50% of the United States homes, so 1 out of every 2 homes that's included in the total broadband market. So 1 out of every 2 houses that is able to have broadband television already has Netflix. So that to me, right, is telling me there's that slow growth there, even though you're only retaining 10% of the overall consumer's television time. You already have 50% of the total market. That there is not a good sign. And even though, I do think now seeing this, I thought that the overall market of Netflix was a lot lower. But in reality, I don't know why I thought about that. If I ask everyone I know has Netflix already. So that's something I do think competition will affect it. 1 out of every 2 households already has Netflix. So now with these extra costs, I do think that some users will back off a little bit out of Netflix. And I'm not gonna lie, I'm one of them that I'm thinking, hey, there's no point in me having Netflix. I'm a huge Disney Star Wars fan, as you can see by my buddies Full Solo and Darth Bear. That I might just stick with Disney Plus. I barely watch enough TV, right? They're saying TV is only 10%. Netflix is only 10% of the television time. So if people are starting seeing that there's no value being added to them, then they are gonna start cutting Netflix as well. I mean, I understand what they were trying to show me with the chart, but I was trying to look a little further into it, and I didn't like the results I came up with. So here I'm going to give a point to Darth Bear. And then there was the end. I think this is the last. Nope, there's two more. Then this is the scary part, though. Cash flow. This company is still burning cash. Let's not beat around this bush. This company burns cash, but the reason it burns cash is because it needs to make new content, and to be able to make new content, it needs to take out loans to be able to pay off that for this new content. And at the moment, they still don't have enough revenue to be able to subscribe with their content, that they have to be blowing cash quarter over quarter. And that's what we saw last quarter. They took off, I forget, was it a $9 billion senior note? I definitely talked about it last quarter. I forgot the actual number. So they're burning. The good thing is they're burning less cash. This quarter they're burning $502 million compared to almost $700 million last year. So they are seeing some improvements. Free cash flow in quarter 3 was negative $551 million compared to negative $859 last quarter. So the first one I mentioned was operating activities. This one was the total free cash flow. For the full year 2019, they expect negative $3.5 billion of cash to blow. Woo! That's a lot of money. They are expecting free cash flow to improve 2020 versus 2019. I'm glad that they can improve a negative $3.5 billion cash flow burn. But that doesn't mean it's going to be positive. That just means it's going to improve. They don't say by how much. They also say they're going to continue to improve annually beyond 2020. So hey, it might be negative $3.3 billion next year. And that's the thing. They are saying improvement, but they're not mentioning any time soon of when they're going to see positive free cash flow. So how much more money can they burn? How much more time before they have to take another loan? Their plan is to continue to use this high yield market in the interim to finance their investments. That's the only thing I think right now is truly helping out Netflix. And it's that the market getting money is pretty cheap right now. Less than 6% in cash and interest on their highest interest that I saw last year. And the other one was like a 3.75% interest. Like I'm saying, cash is free, is pretty much free right now. So it's definitely a good time for companies to take loans. But it's something it's not going to last forever. Obviously, I can't time the market. I don't know when the markets are going to go up, when the market's going to go down. But it's just something to keep in mind in the back of your head and say, hey, if interest rates start to go up, it's going to be harder for this company to take out new debt at a lower price. And the final slide. So obviously here, you know who gets a point here. Darth Bear. So finally, we're going to take a look at next year's reporting. Next year, they're going to start. This is actually starting in quarter 4 2019. Earnings report. They're planning to disclose revenue and membership by region, which is better how they're doing it. Their 4 regions are going to be, instead of just right now, they have United States and international, right? And United States includes just United States. International includes everybody else. They're trying to break it out into 4 regions now: for Asia Pacific, Europe, the first one is APAC, Asia Pacific. The second one is EMEA, Europe, Middle East, and Africa. The next one is LATAM, which is Latin America, and the next one is UCAN, United States and Canada. UCAN is roughly 90% United States and 10% Canada. Canada, step your game up in revenue. Under this new reporting format, they'll also only provide membership guidance for global paid memberships for the next quarter with each earnings. So they're not, they'll only provide membership guidance for. So they're not going to tell us how much they're going to grow per section. What are you trying to hide, Netflix? That's actually not something I want to see. I want to see subscriber growth per region, right? I want to see what you guys are going to do in the United States, not global. that again is not something that's leaving a good taste in my mouth. And as a reminder, they'll no longer report free trial memberships beginning in 2020, as they informed us in Q3 2018's investor letter. Why are you hiding that information from us? That's weird. Like, I can't understand why. Like, I want to understand why they are hiding this information to us. Like, is it really, things going to really look that bad? I enjoy a company to be transparent, and if they were showing us this information back then, why is it so difficult to continue showing it? It's unheard of. That again gives bad taste to my mouth. But thank you guys for watching. I hope you guys enjoyed this episode. I think it was a lot longer than I anticipated to, but I really enjoy looking at this company. I feel like I know this company pretty well by doing all these videos, and I hope you guys have learned something from it. So make sure to subscribe if you guys do. If you guys don't want to watch the videos, make sure to, I do have a podcast. Just put Jose Najarro Stocks. I'm pretty sure you can find it in Apple Tunes, in Apple iTunes, Google Play, and all this. You would find it. So definitely check that out. Give me a thumbs up, post on the comments, and let me know what you guys thought. Take care, guys. Have a good night, and see you next time.